For the last 2 years, investors have cared about one thing and one thing only: more AI spending, more data centers, more GPUs, more scale, more infrastructure, more CapEx. But what if we're approaching the point where spending is still growing, yet no longer accelerating? In markets, that's often where things can change. This week might have been the first sign that investors are beginning to understand that. Basically, in a situation where we could go going from everyone caring about spend and token maxing and AI agents to ROI on investments for AI. Corporations are not necessarily sure what the return on investment is, or maybe they're disappointed by it. You saw Uber come out and say they had blown through their token budget in 4 months. You saw GitHub, switch over to a credit model, and guys were blowing through their token spend almost immediately. June 15th, we have Anthropic ending the era of subsidized credits based their tokens. That will be much more of a price hike. So I think as we move in from the era of subsidized use and everybody can do as much as they want to now optimization, it could change the calculus. It's not really a story of AI spending collapsing, because that's not going to happen. The story is more AI spending moves to second derivative. There's a Goldman chart that came out that shows the year-over-year growth of AI spending. We're kind of at the year-over-year 100% growth. Starts to slow. And even if we get to the 1.1 trillion that a lot of people are kind of the consensus is for next year, it's still a slower growth rate. And that kind of is what matters a lot. Last week, we had a lot of significant things happen. On the ROI front, you had Broadcom come out and they didn't have their AI chips grow as fast as the market wanted. Stock went down 15%. And on the conference call, they basically said, hey, we're not seeing as much productivity from it. Market didn't like that. Second thing that happened was Google announced an $80 billion equity deal in multiple legs of it. And that kind of surprised the market. Didn't surprise me, because I thought that we were getting close, as the CapEx from the hyperscalers has almost exhausted, or has completely exhausted its operating cash flow. And so now they're having to fund it with equity. This was the first equity. Then on Friday, it comes out the Meta is also considering a $20-30 billion raise. So this kind of changed the math and the calculus and the narrative on this spend, this CapEx boom. The CapEx boom for the hyperscalers expected to be at 750 to 800 billion this year, and 1.1 to 1.2 next year. So still growing fast. So you're still in the 50% growth rate, which is a lot, but down from 100. And then the question is, okay, will these data centers get built? There's been a lot of constraints on the data centers getting built: transformers, labor, access to power, pushback from society of many neighborhoods and communities don't want them. So it's not as simple as, hey, I want one and we'll get one. You also had another thing happen, which was that as we come up with the SpaceX IPO this week, we saw XAI actually rent out two of its big data centers down in Memphis to Anthropic 2 weeks ago for $15 billion a year, and then Google last week for around $11 billion a year. And so they've kind of all but dropped Grok as a actual AI lab and moving into basically being a neo cloud, which is a different dynamic than people were thinking, especially with in the SpaceX TAM for the IPO S1, it said 22 trillion of it was AI. So they're probably in the process of rejiggering their offering. Right now, it seems as though we have the AI frontier labs, Anthropic being the leader, and then OpenAI kind of right there with them as the two fighting it out. You have Google with its Gemini and Notebook LM really dominating in the visual area. And then the one thing that's not talked about maybe as much in America as it should be is the open source kind of Chinese models like Manus and DeepSeek and Kimi that are much cheaper. And then the third thing we talk about is not just ROI from what am I spending? Because people don't really understand how to measure it as well. And I'll give you an example of that. You can have one task with two different agents, and it's a different token cost. And people are like, what is going on? So I think you'll see people starting to have measurement, like, how many tokens is it going to cost? Can you put a governor on how many tokens you use? Then there's things called Open Router and Ramp and others, which you route to the model that fits your task. So these are things that have not really been in the marketplace yet. I think we're in this early stage of ramping it up and using it, and it was magical. And it was, for anybody in the knowledge business, it was a big time saver. And now we're going into the phase of, well, what am I actually spending? What's the actual cost? How much am I using for the tokens? How do I allocate this cost across my organization? And so The real risk probably is that we start to see a pause in spending, or not necessarily like a decline, but maybe a pause or deceleration as the enterprise figures out exactly how much they want to spend, what they're getting for their spend. And these things are not really priced for that. Anthropic and OpenAI have filed for IPOs. Their data will come out soon. And we have SpaceX this Friday or Thursday, Friday. And these are now, we're going to have data and we're going to have costs, and Wall Street likes to crunch numbers. So we're moving into the era, which I would say is the next phase of this. When we say, why is so much paper coming to the market? Well, it's a lot of spend. one of the big narratives last couple of years was, hey, this is the Mag 7. These guys have a ton of money they make every year. I think it's $650, $700 billion of cash flow, and basically that they can spend it. Well, they've exhausted that. And so now the next leg of this requires funding from both debt and equity markets. One of the reasons why the equity issuance was surprising is because these companies can still get debt if they wanted to. But the question is, maybe they were going to push over the investment grade market, as the hyperscalers have been the largest incremental driver of new paper in the investment grade market. The investment grade market doesn't have as much capacity as the high yield on a relative basis. Obviously, in terms of total dollars, yes, but they've been filled up a lot, and I'm pretty sure they want to keep spreads in that market under control because it's very important. And remember, we also have the private credit market as part of the data center funding, and that market has been very well noted in the press that there's not everything is as good as it seems, and we could have a situation where maybe there's some pushback there in terms of funding. So you're having some funding, I wouldn't say like red flags, let's call them yellow flags. So you're starting to have concerns from the funding market, but it's not as though it's tipped over or anything. It's just the early signs of it. The SpaceX IPO is 1.75 trillion. It's about $75 billion of paper. Google's $80 billion of paper. Meta's $25 billion. Maybe we'll get an Amazon. You'll have Anthropic and OpenAI. So you add all these up, we're talking about almost you're going to get up to $500 billion. And it will be a very interesting dynamic to see how the market can handle that much paper. Now, it doesn't usually go down just because of issuance, but it just stops the acceleration. And we've just seen the NASDAQ go from up almost over 30%, and then the Korean market up like doubled since March, and the semiconductors, and we just had an absolute killer rally in this whole trade. And so it's interesting when we look at the fact that there might be some changes in the situation, and it's kind of one of those things where it could be a turning point. So what basically happens next will be, okay, how does this paper get accepted? Starting this with Google, then we'll see how the Meta really comes to market, and then we have the big SpaceX deal. Will SpaceX work? I don't know. Trades at 100 times revenue, but now it's kind of changed story also, because with 26 billion of EBITDA or cash flow coming from renting, being a neo cloud, which is a different multiple business. That's just kind of a data center business, which is more of a real estate business. So yes, it's valuable, because when you think about the cost of a 1 gigawatt data center being 50 billion to 80 billion, you can say, okay, well, that's maybe 200 billion of value they have just in the data centers from just the market cost, the equivalent cost. And then you have the Starlink, which is probably $10 billion of EBITDA. If you want to give 25 times, then you're 250 there, and then some kind of value to the launch business, which helps the Starlink business. But you can think of that as a low delta call option. Maybe they could have a colony on Mars, or maybe they could have asteroid mining or whatever. So, it's hard to get to the 1.75 trillion from my seat, but it's Elon, and Elon demands capital. He's the John Law of our era. So I guess when we think about what happens next, I think what we have to watch is, how will corporations talk about spending on their Q2 earnings calls? How will we see deals come? How will their token consumption patterns continue? Will the frontier labs can maintain their lead? Because there's a pretty good thesis out there that the models won't be the differentiator. The constraint will be compute and power access. And then with the subsidized open source from China, as people realize they're spending too much in tokens, how much will move over there, or how much will run locally? So there's a lot of questions, but I think that when you think about things that are valued as high as they are, and people needing to understand that the cost of running an LLM is 100 times the cost of a Google internet search. And when you think about, we move from the traditional software model where it's per seat. So I have a Bloomberg terminal and I pay 30 grand a year for it, but I can use as much as I want. Well, in this new model, it's volume-based pricing. And the one thing that I would let people know is that when we think about who's actually the consumption by the amount of users follows a strong power law where the top 1% is probably using 50% of the tokens or more. And so like the people who are running agents, that run agents and they run their whole workflow off that are consuming much more than the average user who goes on, maybe creates a PowerPoint or uses something for their daily flow, but not nearly at that level. And so it's a small percentage of people using the majority of the tokens. And you have to remember, those people are very sophisticated. Those people know how to use systems, how to route systems. So you would think that as we go forward, that will be the way it goes. And so what is the delta between like Opus 4.8 or they're bringing them up Mythos versus 4.6 or versus Kimi or versus Manus 1.6? And I think that's the thing to think about. And then just been watching how this price hike impacts usage, and not only just usage from total volume, but usage from what they're using. And what will matter is, where are people spending their money and how much money are they going to spend? As we go forward, I think like basically the guys who are probably most at risk of model changes of, the new chip or the new GPU from NVIDIA, that would be the memory guys, because there's something called quadratic compute, where when we run a LLM transformer, the longer the context window, so if you double it, it quadruples the compute. That has been one of the reasons why you've seen memory stocks just absolutely go like rocket ships up, Micron and SanDisk and SK Hynix and Samsung and the Korean stock market itself. That's one area. The semis will be another area. I think that in general, we're looking at a situation where this is a very crowded trade. Now, we had some come off pretty sharply on Friday, recovered today. It's Monday, June 8th. But as we go forward, this is a very expensive market. There's a chart we saw that over half of the S&P trades at 10 times sales or over 10 times sales. And that's a really, really high valuation. And there's a famous quote from Scott McNealy of Sun Microsystems back in the .com, where he lays out exactly what's needed to justify the valuation of that. And so we have a market where it's very much like the K-shaped market, where the top has all the winners and they get all the money, and the bottom, the more traditional GDP-linked companies don't really have that much attention or that much interest. So in that way, the market dynamic is somewhat similar to the .com, and it could be a situation where supply comes online, spending expectations change, margins expectations change, and the funding expectations change, or funding dynamics, I should say, as we talked about. And we could just be at a turning point of this AI trade, which is on year 4. So let's remember, this isn't brand new. Not that it can't keep going or anything. I'm just saying that in markets, it follows a sigmoid. So you're just thinking about the first half of the S is very different dynamics than the second half of the S. I'm Benjamin Bry from Wall Street Beats. Come check us out if you're more interested in more content like this.